So this stock first came out, and then it did what I call an early day reversal. So it started coming out, and then it squatted, but it was still early in the day. I mean, we can probably look at this is a 5-minute here. Right, let's see here. So you see here, it comes out in the morning and then it pulls back right away. And then it just goes through, it sits all day, but we ended up having a strong close here. So that's good. That's good. So that's fine. That's acting perfectly fine. So I'm watching it to see how it acts intraday, that breakout day. Now we look down and we see, okay, the volume was a little bit above average. Okay, that's good. You had a good close. Now these subsequent days, and this is something, if you go to my book, Think and Trade Like a Champion, I show the exact things to look for, that I look for, what you want to look for, what I call confirmations or violations. Is the stock telling you, hey, the train's coming in on schedule, this is acting normal, sit with it and hold it for a bigger move because everything's going as scheduled, or this is concerning. We're starting to see abnormal action, and that's what you want to look at, those first 3, 5, 7, 10 days, and ascertain whether the stock is acting right from day one into the first week or two, and that's going to let you know whether the stock, whether you should be holding it, adding to it, reducing it, and so forth.
And talking about that right side, how tight, basically in general percentages, do you want that right side, that pivot to form at? I think when you spoke earlier at Dr. Rich's class, you mentioned 10% is kind of your guideline, but what do you kind of use?
I'd like it to be single digits. Yep. I would like it to be in the single digits. Now the thing is, especially like on something like this, I have a friend that does some really good fundamental work and likes this company. And so it's set up technically. And so I cut this a little bit of slack here. I would have liked this to tighten up, but I know we're late stage right now. I know there's tons of retail eyes on all these stocks. If there's any kind of base, every Tom, Dick, and Harry is jumping on these stocks, and that's why they're coming out early. They're running up. A lot of them run up and fail because there's just not enough volume in there. It's retail volume. Institutions come in, then they sell right into it. So I'll try these, but if this doesn't work, I'm real tight on this. If this doesn't work and I don't get a good breakout and I don't get the follow through, well, then I'm just going to cut out. I'm going to get out of it. So you just got to be a little more vigilant. Again, I've been doing this for almost 4 decades, probably longer than most people watching this are alive, or certainly as long as they've been trading. So I've got a really good feel and a really, really good sensors, for when things are acting normal or not. But yeah, so you want to see a few that did not work out, or that had some violations? Show you a few. So Burlington, this came out of a perfect base, just real tight right here. You see, you got real tight. The volume came right in, so that's really great. That's setting up just right. Broke out. You had a nice breakout on that day. Look, the volume is well above average. Next day, you start to follow through, but then you reverse. So all this is okay. It's still acting fine. Even the pullback here is okay. But as you start counting the days now you get into day 5, 6, 7, right? So remember I said, watch the first, 3, 4, 5, 6 days up to the first 2 weeks. So we count the days. 1, we got 2 up days, 3, 4, 5, 6, only 2 out of 6 up days, right? You've got 1, 2, 3, 4 lower lows. And on that 4th lower low, it's a bad close. Volume is starting to come up. So now you got some violations. So this, if you have not hit your stop yet, this should definitely get your attention and say, wait a minute, this is not acting right. Now you try to rally back, and this will very often happen where you'll get that rally back and everything's okay, and then bang, then it comes in and you get that gap down. Maybe you go into earnings, or there's some surprise that comes out. So again, this is not acting right, and so you'd be reducing here, reducing or maybe even stopping out. So this is one, and then you see here, it's off, pretty substantially from that point. Another one is, let's see, ATVI, Activision, of course. So this one here, well, let me just make sure I get the right date here. 6/14, right? So that's right here. Yeah. Yep. So bought this coming out right here. And again, let's look at this base. So this is coming out. And again, if you take a look here, you draw a line right across here. It was really clearing most of the supply here. So that looks pretty good. You'd only had a short period of time that it traded above this level. You're pretty tight on the right side. Volume came down. So again, you could get it right. I mean, and it just doesn't mean that it's going to work. That's why you have to embrace it. You got to embrace stops, because half of these plays are not going to work. This is about probabilities, but right away. And what I want it to stop me out immediately. Like if it's going to stop me out, I want to know day one, day two, because then I can redeploy the money and move it into something else that's moving, or go into cash and protect myself if this is the start of a correction and it's starting to be picked up in my names. So I want to know right away, because I want to avoid dead wood. I want to avoid, sitting, sometimes someone will get upset, oh, you got stopped out. They get stopped out right away. Well, would you rather have it go, stop you out 3 months later and you get the same loss, but then you lost 3 months of time? The time is very valuable. Time is money. You want to get compounding, to maximize compounding, you need to compress the time. So I want to know right away. This one, let me know right away. Breaks out next day, bang, right in. This has a couple violations. So see, it comes out here on volume. The next day, you've got a sell off, and the volume's larger.
Higher, yeah.
And then it goes larger the next day too. So that's what I call low volume out, high volume in. So the violations we have here are low volume out, high volume in, close below the 20, close below the 50. Sorry, 1, 2, 3. You got 4 lower lows. So if this hadn't already hit your stop, you should be gone, because there's just too many violations. This is completely abnormal. And then again, you see it tries to rally and then rolls over, because this is under distribution. And that came off quite a bit here. Let's see what else. So ZLAB.
Yep.
ZLAB. This was setting up. I actually tried to buy this coming up from this pullback buy right here. So I tried to get a little head start on it, and right away it didn't act right. And again, you see, right after you get the violations, you get the 4 or 5 lower lows. It closes on its low. You get no follow through. So this is just not acting right. And then it comes back. Like, oh, everything's okay. But see, then the real trouble starts happening. So that abnormal action was giving you that tip off. And then of course that sold off quite a bit. And then of course, what everybody knows, some people got very surprised with this, was Snap. This one here, we were originally buying Snap way back here. This is where I was first buying Snap. And I sold it way too early. I sold it into here, which I believe was the earnings gap. Tried it a few more times. Over here, we actually got back into it, but we got stopped out right on this day right here, which was on 10/18, this outside day. And then a few more days, and then bingo, the big surprise that KO'd a lot of people on this stock. So that was one that we recently stopped out of. So, those are a few examples of stocks that worked and stocks that did not work. And like I said, the key is to pick those warning signs up, and to keep that loss to a minimum. But the main thing is, I know everybody wants to know. They say, well, what's your average loss? What's your batting average? What's important is what your average gain is. That's what's important. The number that you're searching for is your personal average gain. Because let's just say it's 6%. Well, then and your batting averages will just say 50%. Well, then you automatically know, to be at a 2-to-1, you have to average 3% stops, right? It's a mathematical equation. Once you know that information, and you know what your average gain is, you know how many times you're right versus you're losing, your batting average, percentage of winning trades, the loss side, the slider that you have control over. See, these other, think of them as different sliders. Some of them are automated. They're moving on their own. Right. So, but you have control of these few moving parts: what you buy, when you buy, how much you buy, and when you sell. Those are the 4 things that you have complete 100% control over. You don't control how much the stock goes up. You don't control, anything other than those 4 things. So you can't rely upon that. All right. Your reliance has to be on the things that you control. Now, it's all about making assumptions. So what is your assumption based on? I mean, it's just pie in the sky. You just think the stock can go up X amount. That's not what I do. I look at my real results. What am I performing? How am I performing on the upside? And then I choose that stop based on a fraction of that result on the upside.